Hey, what's up, my friend? So here's the thing, right? When it comes to price action trading, most traders, they just know, oh, buy support, sell resistance, wait for a bullish candlestick patterns to form as confirmation, yada yada. Now, there's nothing wrong with that, but if you want to level up your price action trading knowledge, if you want to take it to the advanced level, then you got to be, more versatile. Because price action trading is not just about buying support or selling resistance. It's about trading reversals, buying breakouts, buying pullbacks, knowing when to stay in of the markets and when to stay out of the markets. And if those few concepts are something that you're foreign to or not very familiar with, don't worry, because in today's training video, you'll discover all this and more. Number one, we'll talk about the false break technique, right? How do you actually profit from trap traders? I know that sounds wrong, but I'll explain. The build-up technique, how do you actually identify high probability breakout trades that have a likelihood of follow through. Number three, how do you actually enter a breakout before the breakout? I know that sounds like, kind of like inception, like what the heck did just Rayner say? What the heck did Rayner just say? How do you enter the breakout before the breakout? All that and more in the later part of the video. And finally, the rubber band snap. How to actually avoid low quality trades that has masked themselves as a high probability trading setup, right? So the rubber band snap, right? This technique will show you how to avoid this type of low quality trades. Sounds good? Then let's get started. First thing first, the false break. What is this? So this occurs, right, when the price breaks above a significant high, only to reverse back in the opposite direction. So it looks something like this. Let me just illustrate to you what the false break looks like. Let's say the market is in a range, okay? Then you can see that this is the highs and this is the highs. What the false break will do, it goes up towards the highs of the range, take out these highs, and then it reverses down lower back into this range. This is what I call a false break. Why is it a false break? Because, imagine this, right? When the price breaks above these highs, who will be buying at this point in time? Think about this. Who will be buying when the price breaks out of resistance, when it breaks out of the highs? Well, it will be breakout traders, right? Breakout traders, they love to buy the breakout of the highs or short the lows. And what happens when the price breaks out and then it makes a reversal back into the range? What happens? Well, this becomes a false breakout, and that's why I call it the false break, because breakout traders who buy at the highs, they are now trapped. They are in the red. Because imagine this. If you buy at the highs and the price reverses and goes back into the range, won't you be sitting in the red? Won't you, get stopped out of your trade? Maybe some breakout traders might have their stop loss over here, middle of the range, or some really conservative one, kiasu one, they have it at the lows of this range. So imagine if the price were to continue lower, these clusters of stop loss that I've just highlighted, won't they get triggered? And if those stop losses from the breakout traders get triggered, that would induce further selling pressure. Am I right? Because if you're a breakout trader, you set your stop loss, that stop loss is a sell order. And if those sell order gets triggered, it would fuel more selling pressure. And this is what the false break technique is all about. So let me share with you a few examples. First one over here, can you look at this? This is the false break technique over here. Notice how the price took out these highs over here, right? Took out the highs over here, here, and here. Price took out of the highs and then made a huge sudden reversal lower and closed back within the range. This is what I call a false break. Traders who buy the breakout of these highs, they are now trapped. They are in the red. And imagine if you are the breakout trader, where will you set your stop loss? Well, I'm guessing they'll put it somewhere here, or maybe even below the lows of this range. And if the price continues lower, this cluster of stop loss will get triggered. That induce further selling pressure. And that's what the false break technique is all about. Profiting right from this group of trap traders. Another one, dollar against the Indian rupee. Where is the false break? Over here. Price took out these highs, okay, only to reverse down lower. Dollar against the Indian rupee. Does it make sense? And one more example. A50. China A50, right? This one I zoom out a little bit for you. You can see over here, strong bearish momentum coming down lower into this significant low, right? You can see that the price over here has triggered the lows of here. So traders, right, who are looking to sell the breakdown when the price breaks below this low. Oh, the market is so bearish. Look at the strong bearish momentum, Rayner. This is the type of price action we should be shorting, right? Look at the strong bearish momentum, Rayner. So when the price trades below the lows, they think all hell is going to break loose. They go short, and next thing you know, market made a strong bullish reversal like this over here, closing back into the range, and then it continues to have a follow through up higher. So this is what the false break technique is all about. And a couple of pro tip here that I have shared with you. Number one, I'm looking for strong momentum. The stronger the momentum, the better. And here's why, right? I'll explain that shortly. And second thing is that you want to avoid stair-stepping price action. So what is stair-stepping price action? I'll explain. Say this is the range, okay? Let's say price made one strong bullish move. I call this a strong momentum. This is the type of move that I like to fade against or trade a reversal against. I don't want this type of stair-stepping price action like this, like walking down the stairs, there's a stair-stepping price action. And let's say the market makes a false break and close back over here. I'm not looking to buy at this point. Right? Do you see the difference between the price action of this section over here? Right? Let's say the difference of this price action over here and the difference of this price action, let's say over here. Do you see the type of the move, the wave that comes down? One is that huge velocity, huge momentum, and one is very slow, very jagged. Can you see the difference? And the reason why I avoid the stair-stepping price action is because of this simple reason. Okay, let's like this, okay? It's for this simple reason. When I buy, let's say there's a false break that occurs over here. All these swing highs, they are potential selling pressure. These are places where potential traders will look to short the markets. So if I buy over here, and over here, just at this highs, there are traders who might have the thought, right, of selling the market. That is a so-called one strike against me. That lower the sweetness of the trading setup. Okay, compared to a trade where you just have a sudden momentum down lower, right? Ask yourself, at which point would sellers come in? Possibly at this swing high over here, right? So this means if, let's say, there's a false break that occurs over here, this trade has much more greater profit potential because this could be the entry, and let's say the target profit could be near this level over here. There's much more room for the trade to run, okay, compared to this one over here, which there's really not much of a movement for the trade to run. So this is one thing I look for. Strong momentum into a level whenever I'm trading the false break technique. Number two, a build up, right? So a build up is when a tight consolidation forms, right, prior to the breakout, or sometimes it can be after the breakout as well. Okay, so since you've just learned that, you don't want to be buying breakouts when the market makes a strong move out of this resistance. What you're looking for instead is a build up, and let me just briefly illustrate what a build up looks like. So instead of a strong move into a level, it forms a tight consolidation like this. When you have this tight consolidation, then, only then, you want to be looking to buy the breakout. Why is that? Two reasons. Number one, you have a logical place to set your stop loss. You can just set your stop loss now, right, just below the lows of this build up, and you will have a much tighter stop loss compared to setting at the lows of resistance. Do you agree? Number two, when the price forms a build up, okay, before we talk about that, right, you have to understand that the market moves from a period of high volatility to low volatility. So at this point, when the market is forming a build up, it is in a low volatility environment. And if the price were to break out higher, this is where volatility would pick up. This is where the market can move really fast and furious. And that's to your advantage if you buy the breakout in the right direction. Of course, there's no guarantee the market will break out higher. It could just break down lower as well. That's possible. But the key thing is volatility expansion could really work in your favor. Okay, so this is why I always look for a build up. And one pro tip, a very useful one, is this. You can use a 20 MA to serve as a guideline, which I'll share with you right now. So if you look at Bitcoin, right, it's a market, right, filled with volatility, contraction, and expansion. If you look at this over here, do you see where the build up is from? Let's say this is the area of resistance, okay, and this is, you can see a series of higher lows into this area of resistance. Where is the build up? The build up is over here. Notice how nice and tight this range is. Look at the range of the candles getting smaller and smaller compared to the previous range of the candles where volatility expanded. So we can see that I'm sharing two concepts over here. First concept is volatility expansion leads to volatility contraction. Then contraction leads to expansion again. So see, expansion, okay, then it contracts. After contract, what happens? It expands again over here. Okay, and if you were to buy the breakout of this highs, right, after the build up has formed, okay, you can see that your risk to reward on this trade is favorable. And also, right, the 20 MA, which I've spoke about, right, if you just pull out the 20 MA, because I get it, sometimes you're wondering, right, man, how do I know when is the right time to enter a trade? So if you just use a tool like the 20 MA, I'll just change this to 20. You'll notice, right, that the price would start to hug the 20 MA. So if you're looking to buy, right, you'll notice that the 20 MA will start to touch the lows of the build up. You can see over here, 20 MA has touched to touch the lows of the build up. Does it make sense? Okay, so let me just leave this one here and let me just change this color to red. Okay, there you have it, 20 MA. Another example, look at New Zealand Canadian, another build up that's being formed. At this point, can you see the build up? The build up is over here. Nice tight build up. Then the price, what happens? It then collapses lower. Again, if you just pull out the 20 MA, you can see that the 20 MA are starting to hit the highs of the build up. This tells you that the market is now ready to make a move. No guarantee whether it's going to break out higher or lower. You have no idea, but you can expect something decent coming soon. The longer the build up is formed, the more explosive, the move, would tend to follow. And another example, so for this example, I want to share with you is how the build up actually forms after the breakout. Because sometimes the market might break out of the range first and then it forms a build up. That's possible as well. You got to be, what I call versatile. You cannot just have one eye view and oh, this must definitely happen. No, the market can do anything. In this case, you can see over here, this is the area of resistance. Price actually gap up into resistance and then form this build up over here. Then it broke out, retrace, and then breaks out higher again. Can you see how this build up formed at this point in time in this area? Okay, and this build up actually occurred after the break of resistance. Does it make sense? Good. Now, moving on. The third technique I want to share with you is how to actually trade, a breakout before it occurs. How do you actually position yourself inside a trade before the breakout occurs? Okay, so two things to look for. Number one, identify a build up on the daily time frame. Okay, as what I've just shared with you earlier. Number two, look for a false break on the 4-hour time frame. So can you see that I'm now stacking concepts within concepts? Okay, if all this doesn't make sense, please go back to the start of the video and watch it. I'm building concepts on top of concepts. Okay, if you don't get your foundation right, all this will be very lost on you. So make sure your foundation is there. Okay, so let's revisit the examples I shared earlier. Okay, New Zealand Canadian, where did I talk about the false break? Or rather, where did I talk about the build up that was being formed earlier? It was here. Do you agree? New Zealand Canadian, there was this build up that's formed over here. Now let's go down to a lower time frame, like the 4-hour time frame, and see whether is there any false break trading opportunities that allows us to short at the highs. So I'm going to split up this chart into two. Pew! Okay, this is the daily time frame you saw earlier, and now this is the 4-hour time frame. So let's go to this point in time. Over here you can see. Okay, let me just zoom in this chart. Oops. Okay, here. Okay, you can see over here. This is the build up on the daily time frame, and on the 4-hour, it's this section over here. This section over here. So can you identify the false break setup on this time frame? Well, there are a couple actually if you look at this. Number one is this one over here. This is the first false break that occurred on this time frame, the false break of this highs. Number two, this one over here, another false break that occurred at this highs, taking out this highs and this highs at this point before it reversed. Can you see how this works entering the breakout before the breakout? So a couple of tips for you here, So you can see over here that you might suffer 1 or 2 losing trades before you catch the move, So to kind of manage your trade, what you can do is that, let's say you went short on the first false break, okay, and this one over here. There's no guarantee that if the market goes down low, it's going to break down low. There's no guarantee. So what you can do is take a portion of your position off, at this lows over here. So you have the remaining position, let's say remaining 50%, to ride the next wave down lower should the market break out lower. Okay, so you have some left, in the back, if the market does goes in your favor. If it reverses against you, hey, there's not much of an issue because you already took some profits off. Reverse against you, your loss, is much smaller, or you could even exit at break even. Then over here, another example, let's say you went the short on this false break, you might have taken a portion off at this lows, and when the market break down lower, you still have that remaining 50%, to ride the next wave down lower. Make sense, This is a useful technique, to consider if you're looking to trade the breakout before the breakout. Okay, let's see what else I can share with you. Another example, pound against the Swiss franc. Let me just expand the chart. So pound against the Swiss franc, you can see that again, similar things happening. Over here, there is this tight build up form over here. How do you actually enter the breakout before the breakout? Again, using the same technique that I've shared, use multiple time frame analysis, split the chart into two. You see that over here at this point, on the 4-hour time frame, it looks something like this. Okay? So let me just Get rid of this lines, okay. See, on the daily time frame is this part here. On the 4 hour time frame, it looks something like this. Now, do you see any opportunities to sell in this market? After all, the momentum is lower, trend is down. Over here, do you see something familiar? A false break setup at the highs. How? Interesting, powerful stuff? Give me a thumbs up, right, if you think it's good, right? And subscribe to the YouTube channel if you think it's not good. So this way, you can watch more videos and convince yourself that it's good. Okay, so do it right now. Hit the thumbs up button and subscribe to my YouTube channel, and I'll share with you one more example. This is a potential example. Okay, so let's look at the daily time frame. New Zealand yen right now. Reset chart. Okay, so right now you can see that on the daily time frame, the price is forming somewhat of a build-up. Right? This is not exactly the nice and tight build-up that you saw earlier, but I would still consider this a build-up. And if you go down again to a lower time frame, you can find, right, opportunities to enter a trade before the breakout occurs, before it breaks out of the highs or whether it breaks out the lows. There could be opportunities, right, for you to take advantage of. Let me just go down to the 4 hour time frame here straight. You can see over here on the 4 hour time frame, this is the range that you've seen earlier on the daily time frame. Now you can either look to trade a false break of the highs or the lows, depending on your bias. If you are having a bearish bias, then of course you want to look for a false break setup at this area of resistance. If you have a bullish bias, then look for a false break setup at the lows of support. Does it make sense? Okay? Moving on. The rubber band snap, right? So this technique is about, it's not about entries. It's more of knowing when to stay out of the market. So I want you to stay out of the markets, right? And avoid trading in the direction of the trend when the price is far away from the area of value. I know that's a mouthful. So let me explain, what I mean by this. So if you look at this 30-year treasury market, and if you just overlay with the 50 MA, which I can just do it over here, let's say EMA. For this chart, right, for this particular market, you realize that the area of value is at the 50 period moving average, right? It tested once, twice, thrice, and about 4 times over here. So what I meant earlier is that if the price is far away from the area of value, you want to avoid trading in the direction of the trend. For example, at this point, is the price near or far away from the area of value? Just look at this chart. Ask yourself, is this near or far away from the area of value? And one look, you know that this is quite a distance away from this area of value. I mean, if you want to buy, you can buy, but bear in mind that if you were to buy, let's say at this price, okay, then a proper stop loss, right, has to go below the area of value. If this is the area of value, the 50 MA, it has to go somewhere about here. And you can see that this is a pretty darn wide stop loss, and that greatly, right, reduce your potential R multiple on the trade. Of course, if you don't want to put your stop loss over there, you can put it somewhere here or here. It's really up to you. But bear in mind that if you do this, right, putting your stop loss above the 50 MA, right, when the market makes a pullback, you will likely get stopped out on the trade when it makes a pullback. Okay, so you can see over here, right, market makes a pullback, you will likely get stopped out. But however, let's think about this. Let's say you are a patient trader. You let the market come to you. You trade near an area of value. Now, can you see your stop loss now is much tighter? And it greatly improves your risk to reward. Makes sense? Right, so this is an important tip, right? Not only knowing when to enter a trade, but also knowing when to stay out of the trade, especially when the price is far away from the area of value. One more example, right, before we wrap things up. Okay, so for this one over here, the euro dollar, look at this chart. Where is the area of value? Okay, so you can use a few techniques to define your area of value. You can use moving average, you can use trend lines, trend channels, etc. So in this case, right, I would say the 200 MA is a possible area of value for this market on this time frame, right? Tested quite a number of times here, here, and here. So if the market now, let's say it's somewhere about here, it's far away from this area of value, do you want to be selling? Right? I hope not, because if you also use trend line, let's say if we were to draw trend line over here, just simple trend line analysis. Okay, not trying to get too perfect, just Control C, Control V. Right? You realize that, right now, the price is pretty much near the lows of this trend channel. You want to be selling at the lows of this trend channel that, if the market were to reverse right near the lows, you will likely get stopped out unless your stop loss is above the highs of the trend channel, which is going to be a pretty darn wide stop loss. Okay, so this is the final and important tip that I have for you as well. Don't don't trade far away from an area of value. As much as possible, you want to be as close as possible towards the area of value. Two reasons. Your stop loss is tighter, number one. And number two, it improves your risk to reward on the trade. Quick recap, right? So first one, the false break technique, right? How do you actually profit from trap traders? We are looking for the price to break above the highs and makes a sudden reversal down lower. The build up, right? We are looking for a tight consolidation, right? At the highs of resistance or support, right? Before we trade the breakout. The pre-breakout, right? So this is a combination, right? The pre-breakout is a combination of the false break and the build up. Looking for a build up first on the daily time frame and then go down to a lower time frame and look for a false break setup. And finally, we talk about the rubber band snap. You don't want to be trading when the price is far away from the area of value, because when it makes a pullback, you will likely get stopped out of your trades. Good. So if you have enjoyed this training so far and you still want to, learn more about price action trading, just go down to my website over here, tradingwithrayner.com, and download this guide, the ultimate guide to price action trading. We talk about entries and exits, support, resistance, market structure, and so much more than this video that I've just covered. So go ahead, download, click the orange button. I'll send it to your email address for free. And with that said, I wish you good luck and good trading. I will talk to you soon.